Hello, I'm Steve Forster. Welcome to our project In Pursuit of the Perfect Portfolio. It's my pleasure today to have with us Dr. Charles Ellis, more commonly known as Charlie Ellis, who is joining us today. Charlie is the best-selling author of Winning the Loser's Game and more recently The Index Revolution. He's also the founder of Greenwich Associates, and we're delighted to have you here, Charlie.
Glad to be with you.
I want to take you back to before your investment career. You had your start in radio at
Started at Yale.
At Yale, and then eventually at WGBH.
Yes.
What was that experience like, and what did you take away from that might have helped you later in your career?
Ooh. First of all, it was a lot of fun. The second thing is I learned at Yale that I really liked working with a group of partners, and that a flat organization where we were working together as a team made a huge difference. It's not just you add up talents, but they're different kinds of talents, so you bring them together and all of a sudden you've got much more talent focused on the purpose. That'd be one. Second is the value of strategic thinking, because we did some really interesting things, particularly when you think we were students who should have been in class spending most of our time, and we spent an enormous amount of time working in this organization. But it made a big difference to think long-term and then to work through people and to do that in a partnership or team-like basis. And basically WGBH in Boston was very much the same sort of an experience. Everybody there was older than I was. Everybody there knew more than I did, but I was quote unquote the boss. And so you learn a lot about respect for other people and their talent, and you also learn nobody does anything unless they want to. And they don't do anything well unless they want to. And that if you provide the right opportunities for people to feel inspired and enthusiastic and make that extra commitment, they'll do it.
While you were at WGBH, you started dating a woman who gave you some advice, and she told you about these things called B schools, business schools. And she said to you that Charlie, you ought to go to B school and you ought to go to the Harvard Business School.
Well, she said I should go to the B school. And I said, what is a B school? And she said, business school, for goodness sake. And I said, well, that's nice, but you said the. What does that mean? She said, there's only one. I said, come on, there's got to be more. She said, there's only one you should go to. So that's the Harvard Business School. So I did.
And what was that experience like?
It was
talking
terrific.
About transformational.
Yeah, the school likes to say it's a transformational experience, and almost everybody who's never gone through the school would say that doesn't sound plausible to me. That's a little bit too highfalutin. Anybody who has gone to the school would say, oh yeah, that's exactly what happens. First of all, it's exciting and fun. You're with 80 other students, all of whom are terrified that everybody else must know more than they do, because it seems like the group as a whole knows a lot more than any individual, and that's true. Groups always know more than any individual. The second thing is you learn that you've got an hour and a half to figure out together what is the answer to a problem, but first you got to figure out what is the problem and what's the real problem, not the one that's identified. That's easy. Almost always there's a problem behind the problem that's really driving things. Sometimes it's the problem behind the problem behind the problem behind the problem that's driving things, and it's always about people. So while you do an awful lot of math analysis, what you're really trying to do is figure out, there's a language being spoken here. Language of accounting is part of it, language of interactions and people, but it's always trying to find out what are people trying to do, and how could you organize things so that they could be more successful individually and more successful collectively and more successful over time. And if you get that done, you can be damn sure an hour and a half is just finished, and we're all leaving to go to the next class and do the same thing all over again with another cockamamie problem that is going to gather your attention. You wonder how in the dickens we're going to figure this one out. But looking ahead at things, trying to anticipate things, and always remembering it's all about people, all about people, all about people, every single time.
Down to the people,
Yep.
down to the people. So you're having lunch with a friend of yours, and he tells you that his father's friend, a fellow named Robert Strange, is at Rockefeller, and he's looking for an MBA, and you should apply to it. And what was your thought in terms of what you were getting into, and how did you end up at the Rockefeller family office?
Well, WGBH was obviously not for profit, and I thought, maybe this is a great idea because the Rockefeller Foundation would be kind of interesting. And so I thought, well, I should certainly talk to this guy. But my friend was a sensible person and had good judgment. And I thought, if he's recommending I do this, it's probably a pretty damn good idea. So give it a try. And halfway through the interview with Bob Strange, I realized he's not talking about the foundation. In fact, he doesn't work at the foundation. But I got to find out what he really, really does, because I like this man. He's obviously brilliant, and he's very warm and empathic. And I think I knew I needed to learn a lot. I knew I was green and wet behind the ears. So that was not a problem for me. I knew I was an innocent babe. And I thought, you know, if I worked with this man, I could learn an awful lot. But I better figure out what he's doing for a living, because I don't think I know yet. All I know is what he's not doing. He's not giving money away. It's something else. So the second half hour, I've figured out, yeah, he's in the investment management world, and he's enjoying it greatly, and he finds it intellectually stimulating and interesting. And I thought, well, what the heck? Give it a try. Because a chance to work with a really first-rate human being.
So you got the job, you took the position. You hadn't taken any investment courses at Harvard?
In those days, there was a course on trust administration. It went from 11:30 to 1 o'clock. It was boring, really boring, and since the time was 11:30 to 1, it was called, obviously, Darkness at Noon. Nobody took that course if they could avoid it.
So while you were at Rockefeller Brothers, you then got immersed in terms of some additional learning outside of the office, including what would lead you to a PhD.
Yeah, my first report was so obviously drenched in innocence and ignorance, probably equal proportions to the two. My supervisor said, Charlie, didn't you learn nothing at the Harvard Business School? I said, well, they didn't have any courses, Phil, so I guess the answer is no. And he said, well, you know, just between you and me, this is a rich family, but they ain't that rich. You got to learn something about this. So he sent me to a Wall Street firm to get in their training program and said, and you should take some courses at NYU, which in those days had its teaching facilities in the Wall Street area. So I went down to sign up. I'd been in the Army, so I knew what you do when you see a line. You get in the back of the line and wait till you get to the front. When I got to the front, it was a card table with a typewriter on it. A very nice young woman behind it said, you're next. You a regular student or a regular special student? I said, I'm sorry, I don't know the difference. She said, regular students in a degree program, special students just taking courses. I said, well, which costs the most? She said, the same price. I said, where'd you just fit it? Where have you been in school? I said, well, I just graduated from Harvard Business School. Oh, Harvard Business School, how exciting. You should be in our PhD program. So I signed up for the PhD program, and I got into it. The more I got into it, the more fabulously interesting I found. There were some very, very bright people were doing all kinds of very creative things about investment management in those days, and they were blending it with economics, which I had studied some in college. And it's a fabulous opportunity. So I kept taking classes and took more classes and took more classes. And one day I looked around and said, you know, you're in the PhD program, you're taking an awful lot of classes. You might actually be getting pretty close to earning the degree. So I checked in to find out what was required, and about that time I'd also started Greenwich Associates. And I realized, oh boy, there's a lot of work before you have passed your general exam, and then you've got to do a long paper on a narrow subject. I don't think I can do everything. So I was about to stop when I had a conversation with my son. He said, Dad, let's go shovel. And I knew what he meant. He'd just gotten a boy's shovel for Christmas. So we went out, there was a light snow falling, went out and started doing a little bit of light shoveling. And then after a while I thought he might be tired of that, so I asked him, would you like to stop for a minute and talk? He said, sure. So I said, Harold, how's school? He said, I like school, Dad. Teachers are good, and I like the other kids, and we're learning a lot. How's school with you? And I said, well, Harold, you know, with the new firm, I'm working so hard, I think I'm going to have to stop. Dad, you can't stop school till you finish. So the next day I went back to work at school, and then kept on clunking away. 14 years from start, I had the PhD.
quite an accomplishment given all the other things, and I want to come back to Greenwich Associates in a little while, but lots of other things that were going on in your life at the time,
Sure.
so that was quite an achievement. While you were at the Rockefeller, you had an offer that you couldn't refuse. A friend of yours, a former classmate, was at a little firm known as DLJ,
Right.
and offered you double the salary that you were making, bonus opportunities.
It wasn't double, it was triple.
Triple. Well, there you go. There you go. What was the attraction, and what was the unique position?
Well, the
at
attraction
DLJ?
really wasn't the financial side of it, although my wife had decided to have children, and therefore she was no longer going to be a school teacher, and therefore we were really in trouble living in New York City. So I knew I had to get a job that would pay more. I hadn't realized you could get a job that would pay that much more. But I was at a low base, so triple a small base, it's not gigantic anyway. But the real attraction was a terrific group of people. Bright, enthusiastic, hardworking, very creative, and they were surely going to be one of the driving forces in a new Wall Street. You may remember there was a depression in the 30s, and there was a war in the 40s, and then there was a Cold War in the 50s. So it was a long period of time when nobody went into Wall Street, and certainly nobody of real talent was interested in getting into that field if they had an alternative. There were some marvelously talented people, but honestly, I think they mostly didn't have an alternative that was very attractive. And then we were dynamic as an organization in a world that was dynamic and changing. The people inside the firm were just wonderful, fun people to be with, and we had a great good time being revolutionaries.
Revolutionary in what sense?
Well, it's hard to believe, but if you go back to those days, most securities firms did not have a research department. We were all about research. And secondly, most people put out a report, it would be 2 pages long at the most. We were doing 50, 75, 100, 150 page reports. We were really making an effort to understand the companies very, very well. So we were doing the classic things, talk to the competitors, talk to the suppliers, talk to the customers, and really analyze the companies. And because we had some very, very bright people who were attracted because we had other really bright people, there was a lot of creativity in the organization. And candidly, it was an exciting bunch to be with. There's still very good friends that I made during that period of time.
So what made you then start your own firm, Greenwich Associates? This was 1972. That's quite a big risk that you're taking, going out on your own and developing what now is a world-class consulting firm.
Depends whether you want the true answer or the normally public answer. I'll give you both. The normally public answer is true. It was clear to me that I had no idea how well I was doing. I was working very, very hard. I knew that. I knew that I knew a lot about my individual client, my institutional clients. And I also know I didn't know very much about how they really thought about me, and I didn't know how they thought about any other firm. You know, if anybody could go out and find out what they really think, that would be tremendously valuable to everybody. And that was basically a light bulb. It just kind of came out of the sky, presented itself. Wow, that could be something. Now, at the time, I didn't think of anything outside the United States, and I was really thinking mostly about the securities business and the pension business. It didn't occur to me that commercial banking and investment banking and bond dealing and foreign exchange trading, other financial services would be at all interesting. Didn't occur to me that we'd be working all over Europe and all over Asia, down to the Australia, New Zealand. There are 130 institutional or professional financial markets in the world. And at the end of 30 years, we were covering every one of them. Wow. With the same original idea, although we learned a lot about how to make it better and better and better and better and better and better and more useful to clients. Basic idea is there are 1,000 people or 500 people who are the dominant buyers of a particular service. They know exactly what's going on. They know who's good, what they're good at. They know how they've improved or not improved over the last year. They know what they would like to see more of. And if somebody would come and talk to them candidly for an hour, in confidence, they would tell you. So what we did is in confidence, 1-hour interviews with the principal buyers of one after another, after another, after another major financial service. And we would ask them, which are the firms you use the most in the exact order of their importance to you, and then evaluate those firms, who's really good at this, who's really good at that, who's really good at this, who's really good at that. We never ask who's bad at this or bad at that, because you don't have to. You don't have to. If you're the least athletic kid in your 5th grade class, you know that you're the one that doesn't get chosen for all those teams. Fine.
So was this a revelation to the firms when they
sure
brought back
was.
this information?
Amazing how much you could learn. And we could create the information for the firm as a whole. You could create the information for the Boston institutional investors. You could then create the information for 7 really important Boston institutional investors. We guaranteed everybody confidentiality, so we wouldn't talk about an individual institution. But groups were groups were groups. So if you had a group of clients, I had a group of clients, and we're both serving Boston, we'd run one report on your clients, what they thought about our firm, i.e. you, and if I were responsible for another group, what they thought about our firm, i.e. me. And it made a huge difference in a couple of different ways. First of all, it gave senior management undeniable information. So if they said to anybody, look, this is what the clients are saying about you, that had to be accepted. There was no way you could say no. So then that leads to a lot of accountability and planning, and it's a terrific positive tool. If you can show somebody who's doing well, you're doing well at this, but you're holding yourself back over here, so if you can build that up, you'd really be doing very well. There was tremendous positive reaction that way.
So really this is helping to raise the tide in terms of the investment profession, investment management profession.
Yeah, it really did make a difference that way, but it also made a difference to each individual who was really good and to individuals who were not really good. So if, you know, the old saying, if you delete the duds and enhance the stronger participants, you can't help but improve the overall performance. And if you do it in your firm, then I've got to do it in my firm. These guys are going to do it in their firm, and those guys are going to do it in their firm. Otherwise, they're going to be dropped out.
So some tough markets in tough market environment in the early 70s. You came out with a really impactful and revolutionary and controversial article in 1975 called The Loser's Game, which was inspired by a book on tennis. Can you talk about what went into that article and the reaction to it?
Yeah, let me talk a little bit about the book, because it's really worth celebrating. Simon Ramo was a fabulously wonderful human being on a lot of different levels. People liked him a lot. He was also the Ramo of Thomson Ramo Wooldridge, or TRW, which is the organization that did almost all the general contracting for the American space program. So you could argue sensibly that he, more than any other American, made an enormous impact on the space program, which was an exciting, extraordinarily powerful, and very substantial impact in economics and in society and the way we think about ourselves. So, great industrialist, inspiring leader. He also happened to be a gifted musician. He and 3 members of the Los Angeles Symphony Orchestra played in concert as a quartet. And he happened to be a pretty good athlete. And he, being trained as an engineer, looked on tennis in a way that nobody had ever looked at tennis before. And he realized there are 2 games of tennis, and they use the same equipment, the same court, the same dress code, and they keep score the same way. But other than that, they're completely different. In professional tennis or expert tennis, and there are very few people that really play expert tennis, but there are people, and we've all seen them when you see the Williams sisters or some of the others. They are really good, and they don't make mistakes, but they force the other person to do just a little bit harder to do, a little bit harder to do, and sooner or later, a forced error is made. And they win points most of the time. I don't know about you, but I do know about me. When I play tennis, I play for fun. And I lose points. And I hit it in the net. The really good players never hit it in the net. I double fault. Good players almost never double fault. I hit it out of the court. They don't hit it out of the court, they get close to the line, but they don't hit it. And I give you layup after layup after layup, easy shots you can put away. So he said, you know, you have to understand which game of tennis you're playing. And if you're brilliant athlete, fabulous tennis player, you should play a winning strategy. But if you're not, you should play to not lose. You should be defensive, keep the ball in play. My father-in-law is a terrific athlete. Said if you get the ball back 3 times on every point, you win every match for the rest of your life. And he was right. So loser tennis is what I play. Williams sisters play winning tennis. And once you get that in your mind, it's hard to shake, and you'll see it showing up in one place after another after another. Driving, for example, is don't make mistakes, don't have accidents, don't do anything that's dangerous, and you'll be fine. If you want to be a fabulous Indianapolis 500 driver, that's your choice. But that's a different line of work. Investment management, there are people who are playing a winner's game, and they are doing something that is so beautifully done that you and I would be very confident they'll keep it up. And then there are a lot of people who are in there competing as best they can, but candidly they make mistakes. They buy high and sell low, and they have their portfolio arranged the wrong way, and sooner or later they fall short of what they're trying to do. And because I was working with a large number of different investment management firms, I could see for myself they're all the same in such ways as really bright people who really studied investment management and know a lot about how to do it and how to think about it. They are very good at networking with other people and gathering information. They've got access to terrific information resources, and they are excited about the information they've got. They've got computing power that's terrific. And they're all competing with each other, and they don't realize it's not the market that they're competing with, it's those other guys. And those other guys are pretty good, and it's pretty hard to beat them. And that was the genesis of realizing what Raymond's talking about in tennis applies to investment management. And the name of the article, which the thesis was how to not lose, is realize mistakes are terribly important. Try to avoid mistakes, and called the article The Loser's Game, because the game is dominated not by the winner, but by the loser.
So what was the reaction in the investment profession when this?
Well, everybody I knew was close thought you're going to have a tough reaction. A lot of people are going to be angry. No, not a chance. They all thought, yeah, that's cute. Of course, it doesn't apply to me, but yeah, it applies to a lot of these other guys, but not to me. I'm really doing well.
So then that became the impetus for the book that it eventually morphed into Winning the Loser's Game. And you provide some important insights. And one of the big takeaways from it is that you say winning the loser's game of beating the market is easy. Don't play it. So can you expand on that and other insights in terms of the book?
Well, give you just current information. If you said, I would like to be in the top 25%, top quartile of investment results with my investment manager, I can say to you comfortably, you can do that easily. Well, actually, top 25% is fine, but I'd like to actually be in the top 15%. Can you do that? Yep, I can guarantee you that you'll be in the top 15%. Top 5%? No, I can't guarantee that. Top 15%. Guaranteed? Yeah. Over a 15 or 20-year period, you'll be in the top 15% if you follow my simple guideline. Gee, Charlie, that sounds like a winning proposition. It is. What do? You invest in a low-cost index fund and relax, because it's going to happen. And the reason for that is really something that's important. And let me just take a minute to give you some of the mechanics. Back in the day, 50 years ago, 60 years ago, less than 10% of trading on the New York Stock Exchange was done by institutions. And those institutions, candidly, were mostly regional trust departments that bought blue chip stocks to hold forever And they had an investment committee that chose which ones would be on the approved list, and then younger guys would implement them. This was not an aggressive group of institutions. So you've gone from 9 or 10% institutional, and I put that in quotes, up to now 98, 99% institutional. And those institutions are enormously aggressive, intensive, well-armed, well-staffed, wonderfully competitive people. When you get to the point where I could buy and sell 9 out of 10 times from an amateur who's not involved in the market at all and doesn't honestly know what's really going on, that's one thing. When you step up and you say, anytime I want to buy a stock, I've got to buy it from a guy who knows exactly what I know. And it's just a matter of my judgment on those facts versus his judgment on those facts. That's hard. Now, if you want to sell that stock, you got to sell it to the same kind of person. 50% of the trading is done by either computers, or by the largest institutions in terms of volume of activity. And half of them are hedge funds. These are very rational, hard-hitting, aggressive, and it's hard for anybody who hasn't seen it up close how aggressive is, but they are constantly striving little micro advantages all the time. All got the same tools, all got the same equipment, they've all got the same information, and you're going to buy and sell from those guys, and all you have to do to keep up with the market is earn back your fees, and let's call that 1% of assets, plus your cost of operation. That's either 1% of assets or 2% of assets, depending on how you want to calculate. Let's say it's just 1%. So that's 1 plus 1 is 2, and you've got to earn that back. In what kind of a market? Well, consensus seems to be somewhere between a 6 or 7% return expectation over the next decade. Okay, so let's say 6% just for convenience. 6%, 2%. Holy smokes, I have to do 30%, 33% better than the competition just to break even. Just to keep up with the market, I've got to beat the competition by 33%. Who the dickens is going to be able to do that? Who among us is going to be able to do that? Well, there are some people who think they can, but they're very, very few. And to think that I'm going to find a manager who's going to be able to do that.
It's one thing to look backwards to say a few have, but it's another thing to try and pick those in advance.
That'd be one. The second thing is, let's say we found one. If you could produce 33% rates of return, why wouldn't you just manage your own money? Why do you want to have the burden of carrying my money around with you? So that's a very real problem. And as you know, there have been star managers who've closed down and said, I can do better for my family managing the money on my own than not having to carry all that public money. So it's a major, major change in the world. And what's amazing to me is that we really have stayed with the mythology rather than recognizing the realities underneath it. And the realities are profound, and they are powerful, and they're unrelenting. There's no way that we're going to go back to a time when, oh yeah, let's all go down and beat the market. It just isn't going to happen.
I want to come back to this whole index revolution in just a few minutes. I want to take you back to, you mentioned Yale and your affiliation with Yale, but it goes beyond your undergraduate degree. You were in a position of being the chair of the investment committee for Yale's endowment fund, and you had a front row seat observing David Swensen, and Yale has this fabulous reputation in terms of its endowment fund and really thinking in a non-traditional way. So what is what's become known as the Yale model, and what are the lessons for individual investors?
None.
Okay.
No, that's not true. David would say, oh yes there is, and I would agree with him. No, but the lessons are not the ones of, I'll do what David Swensen's doing. That's what I mean by none. But if you said, look, what should an individual investor do? First, understand who you are and what you're trying to accomplish. So look at Yale. It's a 300-plus-year-old university. It's been around for a long time. It'll probably be around for a long time. Okay, that's pretty important if you convert it into the way in which you would operate. Secondly, while it's located in the United States, it's truly an international phenomenon. Therefore, you would think comfortably about international activity. Third would be that this is an institution that, with a sensible spending rule that smooths, can handle the ups and downs, but it'll always be short on finances, because the people who are involved on the faculty could always use more money to do more creative research and advance humankind. So you really are playing for highest return, therefore heavy on equity, and you want to be diversified so that you don't have a heavy on one kind of equity, but on several different kinds, so you have different characteristics of behavior, so your aggregate portfolio will be more consistent in performing over time than it would be if it was in any one component part. Blend that with the spending rule, you can be quite nervy, as other people would see it. Well, what do you mean by that? Well, 10% in bonds, less than 10% in US equities, listed equities. That's really different. Yes, it is.
Different from what we think of as the historically traditional 60-40 for pension funds, endowments.
Yeah, and most of which, candidly, is following somebody else, is following somebody else, is following somebody else, following somebody else, sort of like the lemmings. How do they get together? They follow each other. If you said, no, I'm going to do that differently, I'm going to think through rigorously what's specific about me, what's important to me, what's my capacity really to handle risk, market risk in particular, and what does it benefit me to absorb riskiness in order to get a higher rate of return. It'll lead you in a very different set of conclusions than, well, I want what everybody else wants. I want 60-40 kind of thing. And it's worth keeping in mind, if you go back 50 years, public pension funds were 95% invested in bonds. Why? Because that's what they were all invested in. Well, does that make any sense? No, it didn't make any sense, but that's what they were. Why 60-40? Well, most actuaries use a 5-year horizon, and if you use a 5-year horizon, you can pretty well work out the risk balance brings you in at 60-40 ratio. If you made that 10-year horizon, you'd be at 70-30. If you make it a 25-year horizon, you'd be at 80-20. It's in the math. It can't be avoided. It just, the calculation comes out that way. So you said, well, how about if you thought in terms of 100? Well, then you come down to most all of it's going to be equity. But human beings don't have 100. So human beings have to think somewhat differently. Second thing is David Swensen and his team are exceedingly rational, which is a wonderful advantage to have. Most human beings, candidly, are not exceedingly rational. That's just not who we are. Another characteristic is they know a lot about the economy, they know a lot about investing, and they know a lot about investment managers. Most of us don't. So they don't have to protect against that kind of innocence or lack of knowledge, or call it by the blunt word, ignorance. They are fearless. And I don't mean that they are cavalier about things that might cause others fear, but they make a point of understanding things so that they can then be fearless. And Yale, because of its depth of knowledge, 30+ years of working with investment managers, and they're working with David Swensen, and there's no one in the investment world that wouldn't be thrilled if they could be the one that gave David an insight or an idea that he found helpful.
Which leads us to this pursuit of a perfect portfolio, if there is such a thing. But
no, there isn't.
Well, let's talk about the portfolio first of all. How do you see one's portfolio, and then we'll talk about the pursuit of it, if there is.
Well, let me just be specific on
Sure.
one thing. For example, people like to point out that Harvard, Yale, and Princeton, for years and years and years, have been very collegial. Stanford is part of that communication. MIT is part of that communication. It's a group of people with the same kind of mission, the same large endowment, same desire to do things creatively and well, and very disciplined, and very bright, engaging people in charge in each case. But Harvard's problem, investment problem, is very different from Yale's investment problem. And Yale's investment problem is very different from MIT. And MIT is very different from Princeton, and Princeton is really different from Stanford. And each of them is so different when you really understand that their investing program should be very different. You and I look like businessmen, fine. You're a professor, I teach. You probably do some things of a business-like nature sometimes. We get along pretty well, similar in many, many ways. If we were in another country, say, yeah, that's North American, you're Canadian, I'm not, but that's all right. I grew up in northern US, spent a lot of time in Canada. My son's married to a Canadian, so there are a lot of different ways in which we're closer than you might think. Okay, but we're really different. Where? Well, when I wear reading glasses, I'll bet that's not quite the same prescription you use. And maybe your collar is the same as mine, but maybe not. And your shoe size might be a little different. And the clothes that you like to wear might be a little different, and the ties that you would prefer might be a little different. And we're just getting started. And then you think of, well, what do you prefer to eat? What's your health condition? What academic disciplines have you pursued? What has been your personal history in investing? We're still getting faster and faster differentiation, and we haven't gotten to the really important things like, what are your assets? How long do you have ahead of you? Are you 99 and you're basically at the end of your run, or are you 9 and you've got a long way to go? Do you have others who are dependent on you, or are you an individual person? Do you have any family members? Do you have any cousins, nephews? Do you have any friends that you're trying to help out in a problem? Have you studied investing all these years, or did you do other things instead? Have you had a wide acquaintance with people in the investment business, and do you chit-chat with them all the time about everything that has to do with investing, and you just can't resist the temptation to talk to another guy, another guy, another guy? Or do you sort of say, no, I don't actually talk with all that many people? Well, gosh, if you haven't spent any time in the Middle East, you haven't spent any time in Japan, you haven't spent any time in Australia and New Zealand, you haven't spent any time in Germany, you haven't spent any time in Canada, you haven't spent any time, how could you possibly know very much different? So pretty soon you realize we're very, very different. And when you go to some investment management, I think it's really worthwhile. How many different colors are required to create the iris of your eye? 6. Okay. So what's the big deal about eyes? Your eye is unique. There is no other person in the world who has quite the same eye that you have. Your fingerprint is unique. Worried about that? Your DNA is unique. You are who you are. And from an investing point of view, if you take age, income, spending, assets, knowledge of investing, comfort with risk, interest in spending more time on investing, access to information, access to judgment, all those characteristics, you know you are unique. And every investor is, whether they want to accept it that way or not, every investor is unique. So what's right for one person isn't, maybe close to right, but isn't quite right. I mean, you and I could swap suit jackets, no problem. But shoes, I'm not so sure. Eyeglasses, I'm pretty sure would be hard.
So I bring this uniqueness to an advisor, and I share all of these attributes that are unique to me.
No, you won't do that. Nobody does that. Nobody ever says, now I'm going to tell you the truth about who I am and what I care about from an investment point of view and what I'm trying to accomplish. That's not what we do. What we do is say, I want to have a good investment program that will do better in the market. And so advisors say, well, tell me a little bit about how you feel about risk. You say, well, I don't mind taking some risk, but I don't want to take too much risk. Do you want to give me any further details? No, that's about the way I feel about it. When is the last really positive experience you had in the investment world? And and please tell me about it. When was the last time you had a really negative experience? Please tell me about that. And then the advisor will try to come up with, are you the kind of guy who should be 60-40 or 70-30? Mm-hmm. And you and that advisor would both be making one of the most obvious mistakes you could possibly make if you stood back from it. You're looking at the portfolio of securities. And that's what you're studying. And you're paying no attention to all the other variables that make a big difference, other than you as a human being, some. But you will not come candid with him, and he won't be able to ask you the right questions, and you won't get there because it takes a lot of disciplined thinking to get exact insight and exact understanding. Now, your tailor can help, and your eyeglasses doctor can help, and if you're married, your spouse can help. Most doctors know that the best way to learn something of diagnosis of a patient is to talk to the spouse, because the spouse can be very, very helpful.
So how should I be looking at a portfolio? Is it too narrow to say, I've got some money that I'm investing? Are there other considerations that I should take into account?
Well, I think so. For an example, are you earning an income? If you're earning an income, I'll give you an example. I teach a course on successful investing at the Yale School of Management. And 75 students show up, and the first assignment is, what will your portfolio's asset mix be at 30, 50, and 70? And the answers come back overwhelmingly, because they all check with the internet and see what's the answer. 30% in bonds at 30, 50% at 50, and 70% at 70. I said, that's got to be wrong. I said, no, it's what we were told. Fine, you were told, but do you do anything else because you were told? No. Okay, let's get back. What have you got? And it's the total. This is when I come to what I urge them to think about always, is the total portfolio. So for an example, at my age, Social Security is part of that total portfolio. Well, that's a very steady amount of money. It's a lot like a bond in terms of what it means to me from an investment point of view. So maybe I ought to think about that as part of my portfolio as a whole, but it's a fixed income type of characteristic. Okay, wife and I own our own home. Well, that's part of your investment portfolio. What's the return on a home? None. It's you basically keep up with inflation, and that's about it. Okay, that's a stable asset, isn't it? So if the market goes up and down, the value of the house change? No. The value of the house stays pretty constant, day in, day out. Okay, so it'll rise enough to basically cover the cost of owning the home and fixing it up from time to time. Yeah, that's about it. Okay, what else have you got? Well, I've got my investments, and my wife's got her investments. We could include those. Should we lump them together? Yeah, I think you probably would. That'd be very sensible. What else? Well, my wife's got an earned income, and I have an earned income. At your age, you're still earning an income? It's because I love doing the work, and people are glad to pay me for it? Yeah, I'm still actually very much enjoy it. Okay, so you want to include all those different component parts? Absolutely, absolutely. Well, how big is the investment part of that total portfolio? Not all that big.
So it's a whole different way to think about our portfolio in a much broader context then.
Oh boy, yes, because if you don't think about the context, you know you're doing yourself a problem, putting the blinkers on and limiting what you could have thought about. And it causes people to say, well, then why would I want to have that much involved in bond investments? And I think that's a really great question. I think everybody ought to be asked that question. You go back to the Yale model. The Yale model starts by going to fundamental questions in every single characteristic of behavior. Is it really the right thing to be doing at Yale? And,
that's what we should be asking ourselves.
we should all be doing that.
So we're all unique, and that's really important. Are there any common elements? You talk about indexing. Is that something that should be pervasive for most investors?
Oh, I think so, but let's just to be realistic. If you read this morning's Wall Street Journal, Burt Malkiel has a nice article in which he reports the data that over the last 15 years, 90% of actively managed mutual funds have underperformed the index. And I can take one more and say, you could never figure out in advance which of those 10% that are going to do better. I think you could a little bit if you spent as much time as I spent in the investments world and you knew as much as I did about individual organizations. I think there are some that are so fundamentally superior in the way in which they're organized and designed. I take the Capital Group that represent the American funds. They are really different. And there are some other organizations that others would say, well, I think you ought to include those. Fine, but you know, let's be fair. I got 50 years head start on that question, and I've studied that organization very carefully, and I know a lot about the way it works and why, and I understand their values and their focus. And one of the main characteristics that nobody pays any attention to is they understand that risk is really important. So they manage risk so that their investors have less risk as well as more return. It's a nice combination, but very hard to pick out very many more.
Are there any other things that I should be thinking about as an individual in terms of pursuing my particular portfolio that's going to be right for me?
Well, let's get one thing really settled. If somebody said to you, look, the data is very clear that 90% of the alternatives don't work out, and it's very hard to choose who's in the 10% that does work out, and even those don't succeed by much. So that's not a game worth playing. That's a huge freedom to be able to say, you know, I can relax on that. I can accept the market rate of return at the market level of risk, knowing it'll happen that way week after week, year after year, decade after decade. Yes, you can. And how do I do that? Low cost indexing. Fine. That's step one. Solves the big operational problem. You still got the question of what's the right structure of a portfolio for you, given all the different characteristics we talked about before. And so it's back to the context again. And the context is you. And that's unique. And therefore, what's the right investing program is something you've still got to, still have to work on, you still need to concentrate on. But the great thing about indexing is it takes the hardest, most complicated part, where you really can't figure out, most likely, and puts it aside and said, rest assured,
So
you're going to do very well. Now you can concentrate on what only you can do, which is figure out who you are, and only you can do, which is what are your values, what are you trying to accomplish?
So you and I might have different allocation of assets.
I would hope so.
But indexing is the way we both should go.
Yep.
Excellent. Charlie, it's clear to see why you've been referred to as the wisest person on Wall Street. You have continued to provide us with all kinds of insights, and I want to thank you for taking the time to join us today.
I promise you, not the wisest, but the luckiest, because I've been in an unbelievably privileged position to watch what's going on through the eyes of some of the best investors in the world. It just happened, but I've been lucky, and the reason I wrote the book is I said, if I've been that lucky, I don't think it would be anywhere near appropriate for me to keep that knowledge to myself. I should share it with others.
Well, we're glad you did.
Thanks.
Thank you very much.